All right, in this explainer, we're going to build a financial framework that's all about protection and strategic growth. We're going to deconstruct how to use some of the most powerful tools in the tax code and really turn them to your advantage.
Okay, so here's our game plan, the 5-part blueprint we're gonna follow. We kick things off with the absolute essential defensive move, protecting yourself from liability. Then we'll flip the script and go on offense, digging into tax mechanics, optimization, and some pretty advanced strategies that can seriously accelerate your financial growth.
First things first, we have to establish the most critical piece of our whole financial fortress. I'm talking about the shield that creates a hard line between your personal life and your business. And believe me, this isn't just about paperwork, it's fundamental protection.
So you have to ask yourself the fundamental question that every single entrepreneur faces. If your business gets into hot water, faces a lawsuit or racks up debt, how do you make 100% sure that your personal stuff, like your house, your car, your savings, is totally safe? Well, the answer is by creating a limited liability company, or an LLC. The name says it all, right? It limits your liability. It's that legal wall we're talking about, a whole separate entity that takes on the risk so that you, as a person, don't have to. And setting up this legal wall is a surprisingly straightforward 6-step process. Now, the first few steps are pretty much just paperwork, but those last 2, they are absolutely crucial. Getting an EIN gives your business its own tax ID, and that separate bank account is the key to actually maintaining that legal separation. If you don't do that, that liability shield you work to build, it could be at risk. Okay, so your personal assets are protected. That's huge. But now, how does the money actually flow through the business? Getting a handle on the tax mechanics, well, that's the next critical layer in our blueprint. By default, an LLC is what's known as a pass-through entity. It's a simple idea, but it's incredibly powerful for tax efficiency. It basically means the business itself doesn't pay taxes. No, instead, all the profits and losses just pass through directly onto your personal tax return. So what's the big deal here? It's all about dodging something called double taxation. See, with a traditional C-Corp, the corporation pays tax on its profits, and then you pay personal income tax on that same money all over again when you get it. The pass-through structure just gets rid of that first layer of tax completely, which can save you a ton of money.
So now that we know how the money flows, let's talk about optimizing it. This is where a strategic choice, a little election, can make a huge difference to your tax bill by targeting one of the biggest taxes that self-employed people face. If you're running a standard LLC, every single dollar of profit you take home is an owner's draw, and it gets hit with self-employment tax. But if you choose to have your LLC taxed as an S-Corp, you can do something really smart. You can split your income into 2 different buckets, a reasonable salary and then additional distributions. And this number, 15.3%, that's what's at stake here. It's the self-employment tax rate for Social Security and Medicare. The S-Corp strategy lets you legally limit that tax so it only applies to the salary part of your income, not the distributions part. Let's make this real. Imagine your business's profits are $140,000. You pay yourself what's called a reasonable salary of, say, $60,000. That part gets hit with the 15.3% tax. But the rest, that big $80,000 chunk, you take as a distribution. And guess what? It is not subject to that tax. That is a massive saving on the largest part of your income. Now look, this isn't something you do one day. An S-Corp comes with some extra admin costs, like running payroll. That's why tax strategists usually point to a profit number around $50,000. Once you hit that mark, the money you save on taxes usually starts to be way more than the cost to keep it all running. All right, now for a real game changer. Seriously, we're gonna shift gears from just saving money on taxes to actively generating powerful tax deductions. And this is often done using assets you might already own, like real estate.
The key mechanism here is called depreciation. You see, the tax code actually recognizes that a building wears out over time, so it lets you deduct a piece of its value every single year. For a typical residential property, that deduction is spread out over 27.5 years. But what if you could take a bunch of those deductions right now, up front? Well, that's the magic of accelerated depreciation. There's a special analysis called a cost segregation study, and what it does is identify all the parts of a property, like the carpet, the appliances, that wear out way faster than the building itself. This study lets you write off those costs in just 5 to 15 years, creating a massive tax deduction right in the beginning. Now, it's really important to understand why this exists. This is not some shady loophole. It's a deliberate incentive from the government. The tax code is literally designed to reward investors for providing housing. So when you use these strategies, you're basically partnering with the government to help them reach their goals.
Yeah, this quote just nails it, doesn't it? Depreciation creates what's called a paper loss, a loss that exists for tax purposes, even while your property's actual value in the real world might be going up. You get a tax break for a loss you didn't even really feel.
Okay, let's put it all together. Let's look at a case study that shows how taking one single asset and combining it with these tax strategies can totally transform your entire financial situation. So how does this actually work? It's a powerful three-step play. First, you use a loan, other people's money, to get control of a big asset. Second, and this is key, you get to depreciate the entire value of the building, not just the small down payment you put in. And third, if you run it as a short-term rental and meet some specific rules, you can use that massive paper loss to wipe out taxable income from your main job. Let's see how this plays out. You've got someone earning a $100,000 salary. They buy a short-term rental. By using accelerated depreciation, they create a $120,000 paper loss in the very first year. That loss is so big it completely cancels out their salary, legally bringing their taxable income all the way down to zero. So the biggest thing to take away from all this is really a shift in how you think. We've gone way beyond just basic defense, protecting your assets. We've moved into highly strategic offense, using the tax code exactly how it was designed to be used. And that brings us to the final thought. When you properly combine liability protection, smart tax choices, and asset strategies like depreciation, your financial structure, it's not just a simple shelter anymore. It becomes a proactive, powerful engine for building wealth. So the real question is, are you using yours to its full potential?